Good evening and welcome to the fifth edition of Budget and Beyond by Emkay Wealth. Every year post the budget, we try to take stock of the situation, decode the budget, and try to crystal gaze beyond into the implications for the financial markets. I'm your host and the moderator for the event today. We are back with an excellent panel. So before we begin, let me introduce our panelists. First up is Mr. Shailesh Haribhakti, who has been a part of all our previous budget discussions, and we are happy and thankful to him for being here today as well.
Delighted to be here.
He has a 5-decade-long career as a chartered accountant, cost accountant, certified internal auditor, financial planner, and a fraud examiner. Welcome, Shailesh bhai.
Thank you.
We also have Mr. A. Balasubramanian, known to all of us in the industry as Bala, who's a very popular face amongst mutual fund investors. Currently the managing director and CEO of Aditya Birla Sun Life AMC. He has been the previous chairman of AMFI and has championed the cause of mutual funds among retail investors. Thank you, Bala, for being here and welcome to the discussion.
Thank you, Ashish.
Mr. Arjun Nagarajan is the chief economist with Sundaram Mutual Fund. He has been involved in pre-budget roundtables with the Prime Minister and the Niti Aayog's discussion on matters related to the economy, and the perfect person to have on this panel discussion today. Welcome, Arjun.
Thank you. Thanks a lot, Mr. Ranwadi.
And to bring in an active hands-on perspective on matters related to the markets, we have the CIO of Tata Asset Management, Mr. Rahul Singh, who has over 26 years of experience in the markets, more notably as the head of equity research in 2 global securities powerhouses. Welcome, Rahul.
Thank you, Ashish. Pleasure to be here.
And finally, Dr. Joseph Thomas, whom we all know as Doc, who has been the face of Emkay Wealth for 5 years and has been guiding investors through his views on asset classes. He is the creator and the master of Emkay's enhanced efficiency model, which has proven itself right time and again. Welcome, Doc.
Thanks, Ashish. Thank you very much.
So I would like to begin the discussion by trying to take away maybe 2 or 3 points or the highlights of the budget from each of the panel discussions. So starting with you, Shailesh bhai.
Thank you, Ashish. So for me, the biggest takeaway has been that the government is finally getting its digital act together. The entire interface between taxpayers and the government is going digital. And so there seems to be now a room to have a cross rating, one by taxpayers of the experience they've had in their tax filing, both direct and indirect, so that it can be fed back to the government and to the various tax authorities who are doing the assessments. And on the other hand, a rating of taxpayers in terms of whether they are platinum, gold, silver, or blue, so that they can be dealt with in a somewhat discriminated manner. And that seems to be a drift of the government, that they will now move towards a very simplified, automated, digital, direct tax regime, as they have done for indirect tax. So that was one big takeaway for me. The other takeaway is that while the digital quality is improving, there is still tremendous scope and room for physical innovation. And that is why we are seeing an immense quantum of investment happening in hard assets. So we'll see defense, railways, roads, and all manner ports, all manners of infrastructure receiving fantastic amount of capital expenditure. And the states are also incentivized to go in for capital expenditure. This is the first time that a carrot and stick approach has been used with states, that if you want a 50-year loan, then you please invest in infrastructure. And the final takeaway for me has been that just following Sabka Saath, Sabka Vikas slogan of this government and of the Prime Minister, we are seeing that center, state, city, district, all kinds of jurisdictions will have to now cooperate in order to really perform and execute the magic that is supposed to happen through this budget. So these would be my 3 takeaways.
Great. Bala, your views?
Yeah. I think my 3 key takeaways, one, I've been mentioning that one is no surprise budget. The reason I'm saying this, every time budget numbers are presented, you do have doubt in the mind that whether the number will math will match or not. Therefore, there's a highly credible budget from the number crunching point of view. Second, as a result of that, I think the number ultimately reflects on you pay respect for the fiscal balance that you have to maintain. Last 2 years is known to all of us, government did not even pay attention to fiscal deficit at all. At that time, the scenario was different. You had to spend money during COVID period, then a Korean War issue came. Therefore, there's absolutely no focus on fiscal, but they were quite prudent in terms of managing the expenditure as well as on revenue. Now that they are seeing a revenue growth, now they have brought back the focus on fiscal consolidation. That I think I see as a prudent policy, given the fact worldwide, wherever fiscal prudence is not there, the market has punished them. So therefore, it's good to have the realization is coming in. And despite keeping the capex investment, public sector capex expenditure much higher than what you have seen in the past, including railways and road infrastructure, 10 plus 3 lakh, 13 lakh crore allocation towards the infrastructure. That means that there is element of growth focus. At the same time, there is element of fiscal prudence focus. And the third, which I again like in the budget, so normally as the taxpayers, we don't expect generally anything, in the sense that we always expect only the middle class income should get and so on and so forth. I think this is the first budget I'm saying is addressing both. We're addressing the needs of people at the 7 lakh rupees salaries. For a change, they were kind enough to do something for the peak tax rates. Also, they are brought in by 3%. 3% peak tax rate at higher end. My own assumption is a decent sum of money, which essentially means they are actually willing to give money in the hands of people for building the consumption-led growth. Therefore, I would say this is a quite holistic budget, both focus on one side investment-led growth, second is consumption-led growth, and third is the fiscal prudence. I don't think ever in the past history we have in such a 3 combinations coming in one budget. So that's something made me feel happy. Even when myself and Shairaj Bhai were there in the ET panel discussion, on the spot we gave 10 out of 10, only keeping this in mind.
Thank you, Bala.
Yeah.
Arjun, what would be your takeaways?
Hi, thanks, Mr. Anwade. So I think 3 broad things. This particular political dispensation, I think they've been very careful about the fiscal part. So even though during COVID they had to really slip on the fiscal front, thank God they didn't really listen to economists and really significantly increase fiscal deficit in a very big way. Sort of kept it in a very targeted sense. So that fiscal consolidation narrative, I think, is very clear from this government, and that's something that they've been doing since FY15, FY16 onwards. So, and from a budget point of view, every year you notice that the budget is actually becoming more of a non-event. It has been over the last 5-10 years. Under this political dispensation, more so, and I think rightly so, because if you look at it from a point of view of capex and revenue expenditure, your capex as a percentage of your total expenditure is roughly around 45 lakh crores. CapEx is roughly around 22% of the entire spending. Outside of CapEx, if you look at RevEx, only 20% of this RevEx is something that you can really manage, move about. The rest, 80% of it is very, very sticky in nature. There's only so much you can do. Rightly so, they're sort of making this a non-event. The CapEx numbers, assumptions are very surprising. They're really very aggressive on the front foot on the CapEx, and it was a little surprising that they were doing this in a pre-election budget. They could have very well kept revenue expenditure at least a little flat. They've brought down revenue expenditure growth from 8% to 1%. There are some adjustments here and there, but then broadly, I think very, very ballsy, if I can use that word, the government to actually go in for such a strong capex push ahead of an election. So my hunch would be that there's something up their sleeve that they have. We'll possibly see over the course of the discussions. Thank you.
Thank you, Arjun. Rahul, your takeaways?
Yeah, I think three key takeaways. Obviously, some of it has been covered, but I think the first positive surprise for me was that obviously there is no populism. There were always a fear before the election year that there would be something populist. In fact, it's been the other way around, that the savings from subsidies, food and fertilizer subsidies have been used for public investment. And I think that is the first key takeaway. And this is the third budget in a row that we have seen that that the capital investment is the focus and not really the freebies, so to say. The second is the thrust on public investment, more so on roads, railways. The second is roads and railways, and also on the social infrastructure around, agriculture, around healthcare, and also around the housing sector, affordable housing. I think the thrust remains very much there. So it's a continuation of that, and it's good to see that despite being in election year, the thrust on the investment cycle continues. And the third one is that, with all this, you would have expected the tax rates to go up, but the tax rates have come down. So I think the government is trying to create a virtuous cycle where higher public investment leads to higher tax income, and that leads to lower overall tax rates. So, I think what they're trying to create, and all the three takeaways, therefore, are connected in a way, because what they're trying to create is a virtuous cycle of, higher GDP growth rate, higher tax to GDP, higher tax revenues, which in turn gives you more money to spend on infrastructure and therefore continue this cycle. So I think everything seems to be connected and well thought out, in my view. And obviously, as Bala said, no surprises was positive for equity markets.
Thank you, Rahul. Doc, your views?
Yeah, Ashish, I feel that one of the things that I would like to highlight here is the continuity. If you look at the budgets in the last so many years, there is an element of continuity. There is a underlying chord that's running through all these budgets, and which is already highlighted in the Saptarishis: inclusive development, reaching the last mile, affordable housing. Some of the things which are very important for the economy is covered, and it's continuum. There is a significant amount of continuity. The second thing is that I feel that there is a greater amount of transparency and with realistic assumptions. Once you look at the budget papers and the documents and all that, it gives us a sense of greater transparency and more realistic assumptions. A third striking thing is the accent on infra. Accent on infra has been there in the earlier budgets also. And it is something which is very, very important for our long-term economic development. So that long-term vision is there, and infra spending and infra accent is yet another thing that is a major takeaway from this budget and a positive of the budget. So it looks at both a social multiplier and a money multiplier to enhance social and economic development.
Thanks, Doc. So one point with most of you mentioned was on the tax part, and I would want to start by asking Shailesh Bhai this question in terms of the overall taxation. And mind it, we have a lot of HNI investors on this, watching us today. So from an HNI perspective, how much has been given in the form of tax cuts at the higher end, and how much has been taken away because there has been a lot of changes, whether it's the capital gains on housing or insurance premiums above 5 lakhs, MLDs, which were used as vehicles by HNI investors, and there's been a lot of investments which have gone into MLDs. How much do you think is going to be the benefit vis-a-vis, the impact?
For all HNIs, the signal seems to be that here's your income, pay the tax. As simple as that. Then we leave you to choose what you will invest in, how you will take care of your retirement, how will you take care of your insurance, how will you take care of your recurring income from past wealth that you have accumulated. That all becomes a choice which will be guided by organizations such as yours. And that seems to be the big thrust. So many of the high net worth individuals will also choose the new system of taxation. Of course, there will be, and my personal guess is that this will rise to 80%. And because this is a default way of making tax payments, we're going to withdraw the alternative altogether in the next 1 or 2 years. So we will have only one tax system, and that will lead to what I call tax determination. So we will not need to file returns anymore. All that will happen is every year we'll get a notice from the government in whatever frequency or whatever geographic distribution they choose, that here's the amount of tax you have to pay, you pay it, and that's the end of the matter. The strange thing is that the largest tax firm in the world is not any of the big four. It is what used to be Thomson Reuters and it has now been taken over by the LSE, which is the largest tax service provider in the world. Because there is one whole Latin American country where the entire tax effort has been taken over by ex-Thomson Reuters, now LSE. Now here is an opportunity for India, learning from our 3 horizontal stacks, to create a vertical tax stack and sell it to the whole world. That is the extent to which innovation, I see, has got crystallized. By utilizing the tax framework, the tax information network, the horizontal stack that we have developed, the identity stack, the payment stack, the DigiLocker stack, all of this is now coming together, whereby a digital public infrastructure has been created, from which we will all start using digital public goods. And that's a huge trend, given the fact that they are investing in all these AI centers and digital libraries and all the rest of it. So it looks like they're trying to make India future ready and export ready. And what have they done to attack the CAD? They're saying now we are going to encourage a massive quantum of inbound tourism. And we are going to disincentive outbound tourism by levying a 20% TCS on remittances that all of us might choose to make, even from our supposedly tax-paid income. We still have to deposit this and see and wait for it to be adjusted against our overall tax bill when it emerges through our current processes. So that's the way I'm looking at life changing for high net worth individuals. And I'm seeing the value and the advice from organizations such as yours becoming even more important.
In fact, I was in conversation with one HNI yesterday, and he mentioned that this government has not issued a single tax-free bond in the last 10 years. And, combine that with the fact that many of the tax loopholes have been plugged is basically indicative of the fact that, there's no escape. But at the same time, there is a message that, the peak rates are going to come down eventually. So as more and more people start paying tax, your peak tax rates would eventually come down. So that's a very interesting observation on the digital part, Shailesh bhai. Bala, coming to you, are you happy with the fiscal glide path which has been outlined by the FN? Because if you see, prior to COVID, our fiscal deficit target was something else. And now COVID has given us the ability to, have a higher fiscal deficit, but then, we have a glide path which is very different from what it was pre-COVID. So how do you see, the current glide path vis-a-vis the previous one?
So I'll just go by a quick reaction on the bond market, how bond market reacted.
Right.
I think immediately after the budget. Bond market reacted positively. The reason is not only they are expecting their 5.9% fiscal number to be announced for next year, and they also given a roadmap. So that's also something is that many were coming back to the FRBM Act. Otherwise, they were not even talking about FRBM for the last 3-4 years. Therefore, this is the first step in the right direction. Second, the context of the world, if you look at it, I think most of the economy in the world, and I think after a very, very long time, we are saying most of the economies have got a fiscal deficit. I think whether it is US, whether it is Europe, we can always see the fiscal deficit can vary from one state to one country to other country. But the fact of the matter is everybody has come to the deficit. And nobody has been actually taking any steps actually at this point of time address it. Worldwide, nobody is talking about it. Therefore, India taking the step, I think probably I would say we are now taking a leadership role as far as the fiscal consolidation concern in the world market. And so that again I see as a positive. Then second is probably I would say the fiscal deficit number they have taken a bit conservatively. I would say, given the fact that as Shailesh bhai mentioned about how tax compliance eventually can improve and single tax kind of things, the TDS what he talked about. So these are some of things from 5% is going 20%. Let us assuming there is some bit of slippage in that. There will be many people who think there's absolutely no point in going to income tax and ask for the refund. I'll rather pay and forget about it. There was a high probability of success on this coming to the government in terms of adding more taxes would also be equally high. I think the new system will bring in new tax collection. Therefore, the current momentum that you are seeing in the tax collections will continue to show a upward growth, which is essentially growing like GST has been growing continuously, direct has been growing continuously, and that's why they have even taken the bet of cutting down the customs duty on those items which are most needed for the making India powerful. So I think they have done a right balance between all these things. So on the basis of which, if you see, they are not counted for any aggressive assumptions are not made. The last point with respect to the fiscal is last 2 years they have been just maintaining 61,000 crores as the PSU divestment. And if you look at it, the pre-budget, the discussion that we had, and then what has come currently in the budget, nothing has come as far as the divestment concern. They have just maintained the same number, running it for the last 2-3 years. Maybe because they're not been successful. At the same time, if you also look at it, kind of the asset that has got built as a country by way of building infrastructure which the government has done, it's all government-owned assets. They are paying assets. Their receivables have been pretty strong in terms of cash flows, but they can easily be in cash. They're still not accounted for it. Therefore, let us assume a scenario they're able to get their asset monitoring right in the next few years. The fiscal consolidation they're talking about 4.5% will not only be met, it can even be overachieved in that sense, I would say, upon achieving few of the moving parts in which they are focusing on get it right.
From the market's perspective, do you think there are any budgetary provisions or allocations which could benefit?
One is, of course, as we discussed, both increase in spending, capex outlay for infra as well as railways. Definitely the ancillary sector that could benefit out of it, I think could be quite large, whether it is an engineering companies or the capital goods companies or in the cement steel kind of demand that could come. I think that one allocation that I think my own belief is could definitely have a larger impact. And second is the whole tax adjustment that they have made, leaving money in the hands of people, which essentially means from a market perspective, I think consumer would have more money to spend. Even if we cut the tax at the top end, which almost about 3% what I talked about earlier, I don't think people will actually use this money for the purpose of saving and putting money in the market. Rather, I think they will probably happy to spend the money. So therefore, the spending in general would go up, whether it is the tourism, whether it is related to the buying consumer durables and so on and so forth. So that I see as an allocation which is I think pretty good. And then the bigger allocation, my own belief is, which will come, I think this is the first time ever the government is actually putting a gun on the state government. I keep a gun on the state government saying, I'm giving you 1 year, you spend the money. Otherwise, the interest-free loan I'm giving is, I think, will not be given. So that means I'm not only giving you money, please go and spend your money. So they've been identified many areas in which state government have. Otherwise, state governments always keep the money, they never spend money. This is the first time ever budget, as we all do in the company. We save the money if the profit not being met. From government point of view, there is no profit focus. There is only a question of fiscal, there's only a reducing fiscal. There is no profit focus there. Therefore, they are saying, take the money and spend the money. Otherwise, I'll not support you. Which I think never in the history has happened. That means every state, whether you like it or not, irrespective of whichever the political party which they belong to, they have to take the money and spend the money. Therefore, the impact of that would be quite significant, both in boosting the local commerce to the all India commerce. So that's the way I see it, which I think never in the history has happened in the budget provisioning.
Right. Arjun, moving to you, there is an enhanced capex from the government. How do you see that in the light of whether that will spur private capex? Where are we on private capex, and is there any connection between the two, or what if private capex also starts pick up? What are your views on that?
Sure. So the capex numbers are very nice. So there is always some opticality to the numbers. So you're looking at the budget capex, it's around 37% year on year. You add the off budget items, it comes down to around 32. And then you notice there is FCI numbers that are actually counted as capex in the off budget items. You have some under the petroleum ministry, you have some under railways as well. So I make all those adjustments. The growth rate in capex comes down to around 20 to 25%. Now, having said that, 20 to 25% is a significant number. It's still a very, very high number to actually see from a capex point of view. Now, two things on capex. Yes, there is a concern of crowding out, but if you look at where private capex is today, it is still not really, it has still not really picked up enough steam for that crowding out concern to sort of play out. So if you look at capex announcements per se, I think last fiscal you had largely it was metals driven. This time around it seems to be largely renewables driven. So if you look at it from a private capex point of view, I don't think we are at that point where private capex from a crowding out point of view is at threat. And I would suspect that the government has pushed up the capex numbers, pushed up the borrowing numbers, especially driven by these capex numbers, expecting that private capex will be at least range bound for FY24. I would think that is their baseline assumption, and so they don't really see market borrowing as a concern, rather crowding out as a concern.
Do you think there is any risk in terms of implementation going forward?
On the capex numbers?
Yeah.
Okay. Okay, let me put it this way. So if I look at,
have they been able to, what was announced last year vis-a-vis what's been done?
So if you look at last year, they had announced 7.5. They did around 7.2. But if you look at this particular, so I'm going by dispensation. So from FY 2000, from 2000 on, if you actually look at every single budget, the previous political dispensations, and it was also the pressures, global pressures, or the pressures of the day, that whenever there was pressure on the fiscal, the first go-to was to cut down on capex. So if you accounted for 100 rupees on capex, at the end of the year, this fiscal pressure, you bring it down to 95, 96%, or 98%. This particular political dispensation, very objectively, you look at the numbers, most of the time they've delivered more than what they had budgeted themselves. And like you can see in all the budgets, the last 3-4 budgets, they've refrained from populism, and their assumptions are intentionally on the receipt side, the growth side. They're very conservative because they want to keep the numbers down and have positive surprises. So a risk of a capex slippage, I wouldn't really, I think at least the probability of that in my eyes at this point in time is low. But having said that, if we see growth come off much sharper than what we possibly had expected globally and domestically, I can't rule that out as a possibility. They might have to sort of shave off a little on capex. I can't take that out as a possibility at all.
Okay. And you think, assuming that they stick to the numbers, do you think there is a possibility of overdoing it, given that, we are in a pre-election year? There could be slippages on the fiscal.
Overdoing capex, I wouldn't want to keep that as my base case. Maybe overdoing some of those numbers on the revenue side, maybe. Say, for example, one way of looking at it, there's been a lot of noise about how MNREGA, the allocations have actually cut down. But if you look at it on the whole, so the amount of money that is going to rural, the large chunk of it, the reason why on year on year it's actually down nearly 10-11% is largely because subsidies are going away. Subsidies are now coming off to just under 2 lakh crores or so. Now, if you take the subsidies component out, I think you still see on the rural side 6-7% growth in spends. So what would have actually gone under MNREGA is actually now coming under Gramin, the housing that is actually rural housing. And it's actually a very significant positive because they have not just allocated more. The last 3 years, they have also been doing much more. So I think there's a fair bit there. So if at all there's any risk of overspending, I would think it's more on the rural side rather than on the capex side. The other bit is on the numbers. Your nominal GDP assumptions are also fairly okay. So the receipt side, the only part where maybe you can see there's some optimism is the GST numbers. They're taking 10 basis points more tax buoyancy. Everything else as a percentage of GDP is exactly flat as it was in FY23. So that conservatism is very much there. So if it's very likely that you will see higher receipts than what they had actually budgeted, provided growth also holds up. So risk of capex getting overdone, I would think no. They have some allocations under the food subsidy, under the FCI, in the off-budget items that is still not clearly explained. And at a point in time where they've sort of cleaned up the entire off-balance sheet items a couple of years ago, there's a fairly sizable number there in the off-budget of around 1.4 lakh crores that the FCI is borrowing. So my only hunch would be that I can't rule out the possibility of them giving a reasonable MSP hike in 2023. Also, given that global commodity prices are elevated, they did not really increase it last year. Global commodity prices are elevated, and historically, you look at it, the entire MSP hikes are directly linked with how global commodity prices move. So I think I can't really rule that out as a possibility. So that could be one reason.
Got it. Rahul, coming to you, the government has, been supporting various industries through the PLI schemes, and even in this budget, we've seen some duty rates go up and down. As an equity investor, which are the sectors one should look at, from an immediate 1 year point of view and say from a 3 year point of view? Is there anything which is looking very interesting from a sector perspective?
So let me take a step back and talk about what's happened in the last decade, where primarily our economy has been driven by consumption and to some extent exports, and that too of only IT services. What we are seeing is a little bit of a minor inflection point in the cycle where investment cycle is also beginning to play a role. Obviously, it was led by government. Most of the heavy lifting was done by the government, and as a previous panelist mentioned, I think the next year also they are budgeting for the same. But we are seeing early signs of private capex coming up. We have seen real estate recover. So essentially, irrespective of this budget, we are already seeing a sign of certain parts of the capex cycle or the investment cycle reviving over this last 1 or 2 years, which the government and the budget is just giving further thrust to. So the government is just adding more fuel to fire, so to say, and that is positive for these sectors, the allied sectors to industrial, capital goods, manufacturing, real estate allied sector. These are the sectors which can do really well over the next 1 to 3 years. Added to this is another point I would like to make is that as a country, we have missed the manufacturing exports train over the last 30 years. And there are, East Asian, Southeast Asian, East Asian countries, which have been growing, including China, for 20 years at much higher pace than what we could. Where we could only focus on was on IT services has been our only major success, and pharma to some extent, and now chemicals. So as a country, I think we are getting a second chance thanks to the geopolitical situation, thanks to COVID, and thanks to China Plus One gathering steam, and that everyone wants to diversify and have another source, and India is obviously coming up as a viable alternative despite its infrastructure bottlenecks and despite higher cost. Earlier I think commercials used to never mean that Indian companies would get a look in terms of creating any major scale in exports. But now what's happening is even if your costs are higher with a little bit of help from PLI, even if your costs are higher than China, I think we are getting a look in. I mean, what else does Apple getting into India explain? It's not that we are going to make phones cheaper than China in the next 5 years. In no way, it's not going to happen. So I think government is trying to create an ecosystem through the budget, through the previous PLI schemes that they're just trying to add fuel to the fire, which already exists. So these are the sectors I think which look extremely interesting. Of course, we have to look at company by company, and each company is different from the other company. The dynamics are different for each capital goods or industrial company or a manufacturing company, and more importantly, the management has to be ready to realize that there is an opportunity and there is a 5 to 10 year opportunity. So it all comes down to that there is an ecosystem, there are tailwinds, but which are the companies, which are the sectors which are really able to take advantage of that? I think it's an exciting time. I mean, I can tell you that as fund managers, it's a very exciting time for us to be doing bottom-up stock picking. Because we think there is alpha to be made in some of these mega trends which are emerging. So sorry, long answer and slightly different from the budget, but I just thought this is something which is important for the listeners to understand.
Got it. Also from equity markets perspective, we are one of the expensive markets globally. And I think one of the reasons has been Indian investors have been putting money into the Indian markets at a time when global investors have been moving away. The US market has fallen quite significantly, and we continue to hold, at levels which are, near the high levels. At this point in time, and I'm asking this question because, we would like the foreign investors to come back. From a relative attractiveness point of view, when the US market's cheaper, do you think foreign investors will come to India? That's number one. And if they eventually are going to, when do you think is, that likely from your, point of view?
So if I were to look at it very objectively, Ashish, I think the there are two layers of the answer has two layers. One is that China is reopening and reopening with a vengeance after 2.5, 3 years of suppressed activity. So we all saw what happened in the Indian economy after Omicron and after the lockdown. I mean, the so-called revenge buying is still continuing in the urban markets at least. So imagine with the buying power which China has, what kind of economic activity burst we can have in the next 6 months. So if you look at it from a short-term perspective, next 6 months, I think China is going to be tactically more important for the FIIs to focus on, because the valuation premium, although it has come down from 80% levels, it's still pretty steep at 65-70%. In the last few weeks, the premium has come down from 80-90%, but still steep. If you look at the historical premium which India has traded at, we have traded at about 50% premium, 45-50% premium. So I'm not suggesting we will go there and we will continue to underperform that significantly. But I think in the next 6 months, maybe the 65-70% premium to China will keep drifting down, partly because China does better. We move sideways from here, and that should complete the process. Obviously, things are not as simple as I'm telling you. There could be shocks in between. There could be more volatility in between, but by and large, that's the scenario. The other thing interesting to remember is that that most of the reason why India outperformed significantly last 2 years is because, or last 1.5 years, is because there is a serious threat of a recession in US and the European region. And we as a country, apart from IT services, are not really interlinked so much with the global economy. And even our IT services companies don't fall off the cliff. Their growth comes down from 15-20% to 6-7%. So we are that way a low beta emerging market. And therefore, if the recession in the US and European region is not as bad as is being feared, and if Fed is able to create a soft landing, then obviously India's importance as a market continues to suffer. This is not to say that we will, our valuations will come down 20-30%, but maybe the other emerging markets valuations will catch up. So I would say 6 to 9 months, there is more probability of that happening. And that is when we will create a base. And if we move sideways from here, we will start looking much more reasonable, say 6-9 months down the line, at 17 times, 16.5, 17 times P. But having said that, I think even if index remains flat, as I was mentioning, the changes in the economy is giving us enough opportunities to look at pockets which have not done well over the last decade almost, including some of the pockets in the so-called value segment, and create alpha from there.
Okay, that's very interesting. A follow-up question on the China thing which you mentioned. Given what China's done to Jack Ma and corporate espionage episodes with Huawei, and the global majors trying to block China from having access to technology, etc., do you still feel that foreign institutional investors who generally preach on governance and all of those issues would still want to go into China?
There is a pool of money which does not care too much about it. So tactically, yes. But to answer your question, and I know where you're getting it, I think at a long-term conviction remains low on China. There is no doubt. But there is a pullback. There is an unlock. I mean, there is a real unlock possibility in terms of economic activity. I think investors would tactically play that, in my view. Again, I'm talking on behalf of the FIIs, but even in FII, there are various types of FIIs. So one has to keep that in mind. But you're right that the overall confidence on China has suffered a permanent kind of a setback. So they are never going to. India is never going to go back to just 20-30% premium of China. I think we will have a much higher base of valuation relative to China than what has been the history in the last 10-15 years.
Right. Shailesh bhai, one question to you, given the recent episode with Hindenburg and the Adani Group. Do you think the credibility of India Incorporated is likely to be impacted?
Ashish, that's a very interesting question that all of us must consider very carefully. As I sort of feel the pulse of governance, because I sit on so many boards, I think we are only getting better at governance. People are speaking up. There is a culture which says that we are not going to tolerate and permit non-compliances and permit not so clear ways of operating and all of that. And therefore, I think we were winning in the race for becoming more respected in terms of governance. Now, what Hindenburg has done is it has created suspicion. And it is very critical that we deal with this suspicion very squarely. And we deal with it with an iron hand to make sure that we continue along the path of better governance. Particularly, it is important that we show that our ESG credentials, all of them, the E, S, and the G, you have asked me only the G question, but I'm saying in all these three, we will have to show ourselves to be very conscientious and double up the efforts of corporate India and particularly the government of India to show that we mean business. So here's a thought that I wanted to share today with the FM, but of course there was no time. Take this whole coming together, the collaboration idea which I talked about in the very beginning. Why can the government not promote 2 or 3 radical ideas, like cleaning up all water bodies in India of plastic? It's very feasible to do that. It's also very feasible to look at how can we bring food waste to zero. And these kind of big ticket, visible ESG ideas can now be taken up because one, Davos, the big word that came out of Davos this year was polycrisis. So multiple kinds of crises going on all over the world. What can be done is we can take the lead and show that we can get in 18 months' time, every water body in India rid of plastic. Or we can show that we can make sure food waste will come down to zero. If we are able to bring this energy together, then our reputation and our whole image will go through yet another large filler. So it's not a Adani or it's not a Hindenburg. It's a question of the whole country and the whole government, everybody working together to make these big things visible to the world. So we are capable today, technology-wise.
Got it. Bala, my next set of questions to you. Mutual funds have effectively been capped from launching new funds which invest overseas. And now there is a 20% TCS on LRS remittances if investors want to invest overseas. With the US markets at the levels at which they are, I mean, for me as an investor, it's a great time to be bottom fishing or looking at the US investment, US markets from an investment point of view. What is the government trying to signal to us here as you know, as an investor community? Is there a message which is trying to come out?
I think what this has been under discussion for quite some time, Ashish. The sense since the time the $7 billion limit got utilized, there has been a continuous representation have been happening with the government as well as the RBI and also the SEBI. In this case, even SEBI them also wrote to RBI recommending the limit to be increased to $14 billion from 7 to 14. Ministry of Finance also did write that point of time. But Reserve Bank of India did not do it for one simple reason. Today, the current the forex balance we have from a period of covering the import of roughly about 16 months or 17 months or maybe 14 months. Now it's come down 9 months. So the what is the need of the hour? Is it remitting money overseas or bringing in money into the country? So probably I would assume that's the way I think they would have taken a call. In fact, they have repeatedly said that is not the right time for that limit to go up. At the same time, they were under the assumptions LRS anyways is there, and under the LRS route we can always put the money. Therefore, they never claimed the LRS limit. I think they also have realized the people who have been remitting LRS, they have also found they are not high taxpayers for a variety of reasons. And therefore, the people who are remitting money overseas, the tax compliance either could be less, or maybe the tax payout that they have could be less, or maybe the money doesn't come back. Therefore, the money stays overseas. Therefore, you don't need any pay tax on that. So now they have made it the TCS that they have introduced 20%. Though the amount looks large, no doubt. I think if you put $100 and $20 is towards the TCS and 80 goes towards investing, then actually you need to have more money in your hand. So at the same time, they're not saying don't do LRS. So you can still do it. The question is the amount that is available for you is actually becoming less. So that's something I think what investors have to understand. At the same time, as long as you're able to treat this as an advance payment, and then you adjust against your taxes at the end of the year you pay. So it's more of a cash flow mismatch. At the same time, if somebody slips away with the compliance part and therefore the government is end up getting more money, so be it. And that's the way I think they are looking at it. Therefore, government I think is not very keen at this point of time increase the limit of $7 billion to higher number. As for the LRS concerns, they could easily stop it, despite given the fact that we have a currency reserves only for 9 months. They have stopped it, which again, that means they are not discouraging. At the same time, if you still want to go ahead, keep upfront money of 20% and then balance it, take it out, no issues. It can be even considered as over and above that $100,000, which any individuals can remit. $250,000 any individuals can remit. Even the TDS can even sit over and above the dollar also. So they don't, I don't think they are caring about it. As far as the market concerns, they did have today call with the meeting with the finance minister, and it has come in the money control. I just saw it, wherein the question was asked about inclusion of the Indian bonds in the global bond index. So that's been pending for quite some time. And I think government seemed very clear that not to have dollar bond index overseas, given the fear that times like today, when the global market goes through a volatile period, whether the bond index overseas will behave properly or not, it can come under attack for a variety of reasons, because that is not in your hand. Therefore, they want to actually get money into the country, money go out of the country at our condition. And that's something seems to be one of the agendas there with the government. If anybody wants to put money in India, so you cannot dictate terms, it has to be at our terms kind. And the same thing they are doing as well the reverse concern.
Right.
Yeah.
Well, I know you have to leave at 5, so my next question is also to you.
Yes.
As a bond investor, what kind of strategy should one follow? Because the yield curve is now effectively flat. So from a duration perspective, what kind of strategy can a HNI investor follow?
I think bond investing concern, one assumption that at this point of time is worth making is the interest rate peak cycle has come almost close to the peak. Maybe another 20 basis points rate hike could come, which will take the terminal rate about 6.5. And bond yields, because of the 6.5 repo rate, even if you keep about 100 basis points spread over repo rate, your 10-year should be somewhere around 7.5. If 10 years 7.5, repo rate 6.5, then the whether it is 1 year you take, or 2 year rate, or 5 year you take, is going to be more or less a flat curve. So essentially, from investors' point of view, the great opportunity that has come for HNIs. There is a new avatar of FMP has come in the form of target maturity fund, which invests in, of course, 100% AAA, 100% G-Secs and SDLs, and it can be considered for any period. You can do it for 3-year period, 5-year period, 10-year period. So that's something which has come, and definitely that makes sense for people to go for these investments rather than going for FDs. Given the fact here you get a tax adjusted return, better return. Second, given the also fact that in the year 2024, early part of 2024, maybe you may also see surprise coming from US after 9 months cutting down the rates by about 20 basis points. If the inflation settle down very fast, and if they also see, even if you get a first sign of the economy in US will get into the recession, they may probably take the plunge of cutting the interest rates by 20 basis points, and that down cycle could begin. So keeping that in mind, if the interest rate differential between India and US become more favorable for even RBI to cut the rate, which hopefully we should see it happening in the 2024. Therefore, from bond investors' point of view, can even look at 3 to 5 year kind of duration open-ended funds. Keeping in mind is coming for 3 years. Also keeping in mind, after say 18 months, if this cycle down cycle starts, then you also get the benefit out of that. So that's where we see as far as the bond market concerns. I think this is the great period after 2.5 years of no opportunity didn't come. That seems to be coming in now, at least for this to stay for at least 3 years. Given the assumption we make is the current elevated rate of interest will not be brought down as quickly as possible as market has been expecting, because this also ultimately doesn't cost anybody. At the same time, it definitely benefits the savers in general.
Got it.
Yeah.
Thank you, Bala. Thank you for being here with us. I know you have to leave at 5 o'clock, so thank you for being a part of this panel.
Yeah, thanks, Ajay. It's my pleasure. Yeah, thank you.
A couple of more questions before we leave it open for the participants. Shailesh bhai, we've been hearing about the gift city and provisions being announced, whether for Indians to invest through the gift city or for foreign portfolio investors to bring in money through the gift city. I mean, what's happening there? Again, there were some provisions this time as well that P notes are back through the gift city route. What's happening then? How do you see the whole gift city experiment panning out?
Ashish, I'm a great believer that Gift City will be a success. I can't tell you when, but I've seen personally the physical infrastructure they've put up there, and it is phenomenal. It's absolutely impressive. The infrastructure is in place, the physical. The legal infrastructure is also in place. And we should not get carried away by this talk of P notes, because the UBO regulation and the exchange of information that is now in place between various economies will not permit the hot money rushing in just because Gift City has opened up. That is not likely to happen. But the incentivization of making India through the Gift City as a financial center, I think is very high. And that is why I believe that we will see a tremendous spurt in goods passing through Gift City, in financial services passing through Gift City, and whatever markets that we have exported already because of the adverse laws that we had compared to other economies will start flowing back. So I see Gift City as a fantastic experiment which will succeed. I hope it succeeds faster than slower.
Right. My next question is to Arjun. We are in a situation where there's global slowdown. India is growing faster and one of the fastest growing economy in the world. If the trade deficit tips badly, as in we are not able to export because of the slowdown in the US and Europe, but because of our own growth, if imports start rising and there is a trade balance tips very badly and the current account deficit increases, how vulnerable is the rupee to all of this happening? And again, assuming that the FPIs don't come, the money doesn't come, how much do you think is the rupee vulnerable to this?
Fair question. So short answer, the rupee is vulnerable. Now, long answer, if you look at our trade deficit, rather our CAD, you have two parts to it. One is our services and our trade. On the services front, we are actually on a surplus. And the last 3 years, we've actually seen our run rate on services here a fair bit of a pickup. That was something that we hadn't really expected at all. Now, on the trade front, a sustainable trade deficit number is in the range of around 10 to 15 billion per month. We are running at 22 to 25 billion per month, which is definitely not sustainable. Now, having said that, it's sort of holding up because our FDI flows are fairly okay. FII flows were fairly weak over the last 1.5, 2 years, but thanks to the fact that the Fed aggression really didn't happen as fast during that phase, that you had a lot of money coming in through ECBs as well. You had a lot of non-FII money, non-FDI money that sort of helped the rupee to an extent. The other context to this entire thing is every year we are a trade deficit country. Our currency depreciates by around 3.5% every single year. So if any particular year your currency does not depreciate, there will be a catch up that happens the year after. And that is exactly what you saw in 2022, in addition to whatever incremental volatility that you had. So from a flows point of view, there is a fair bit of volatility. So the rupee is in the spot from a volatility point of view, but what's helping the rupee, at least emerging market currencies at this point in time, is that the Fed is very close to a peak on the rate hike. There's one more rate hike is broadly what the markets are expecting. And after that happens, the Federal Reserve is not going to hike rates, which means incremental dollar strengthening is very unlikely. To the contrary, you will see the European Central Bank raise rates, continue to raise rates for another 6 to 8 months after the Fed stops, and which is why there is a fair bit of an expectation that the euro will start strengthening. There are even estimates of the euro touching 1.15 or so to the dollar from the current 1.08 number. Now, what this all means is that the dollar index will remain flat to weak in most part of 2023, which gives emerging markets a breather. Now, coming to the rupee in particular, it's a very interesting part is that whenever the rupee's rank within the emerging market or the Asian emerging market pack slips, it comes in focus only when it slips during a depreciation. During an appreciation, if you see the rank slipping, it doesn't really create too much of a concern. So, for example, as we speak now, within the Asian emerging market countries of around 12 countries or so, we've actually slipped nearly 11 out of 12. But it's not creating too much of noise because the rupee is not depreciating. So that is something to actually keep an eye out for. But yes, long story short, there is concern. But given that the dollar weakness is going to play out for a good part of 2023, I don't think it will really translate into something very material. Also, because the RBI has been simply wonderful when it comes to managing the rupee and trying to really see to it that the volatility is very, very contained.
Thanks. Central banks have been buying gold. I think last 3 months, significant amount of gold has been bought. And I think that's probably one of the reasons why gold prices have gone up. How do you see gold as an investment for HNIs at this point in time? Because typically gold has a tendency to perform in spurts and then go to sleep for a long period of time. It's been sleeping now for a very, very long period of time. I think this level was last seen in 2011. I don't think it has been able to break that level which was seen in 2011. What is your view on gold and even silver for that matter? And what would be your advice to HNI investors?
Yeah, Ashish, gold has been dormant for a long time now, despite the fact that inflation has been at very high levels in almost all the economies of the world. Recently, we had seen some buying coming in from central banks. Now, there are two factors which support a rise in the price of gold. The first factor is that there's a fear that there will be a recession in all the major economies. And it is actually going to be at least a touch and go recession, even if though it could be a weak kind of an economic sluggishness, it's going to be there in the US, Europe, and the rest of the world. That should prop up gold to some extent. The second factor that could help gold is the fact that the dollar index has moved down all the way from 114 to now 103. Yesterday it closed at 103. And it moved up, in fact, from 101 to 103. So it shows that dollar is progressively becoming weaker and weaker. So the strength of the dollar, which has dominated the markets for almost a year now, it's gradually waning. So the weakness of the US dollar and the fall in the dollar index, again, is going to give good strength to the metals like gold and silver. When it comes to gold, if gold runs at say a pace of 1, silver will run at a pace of 10. That's the kind of relationship these two have. We look at it as a good opportunity to invest into gold with a 1-year time horizon, may not be longer. And one could access gold through gold funds, gold ETFs, or even sovereign gold bonds. So it's an tactical kind of opportunity, maybe could be utilized for the next 1 year.
Doc, where do you see are the other investment opportunities in this calendar year for our HNA investors?
Yeah, Ashish, in any case, we continue to recommend equities, and in equities, we are bullish on manufacturing. We are also recommending tech, because tech having been sold off heavily, and tech companies are expected to do quite well, and those are the companies which have weathered the storms. Even when from Y2K till today, they have seen the great recession and so many ups and downs, so they are expected to do well. Banking and financial services will also do very well, because they have healthier and stronger balance sheets. SBI itself reported the highest PAT in its whole history, and we feel that BFSI is a sector to be invested into. Even with the rising interest rates, the net interest margins could gradually pick up, because of the fact that the deposit rates and the borrowing rates will adjust quite relatively at a lower pace compared to the lending rates. BFSI manufacturing is a theme that we have been looking at very closely. It's mainly because the economy is expected to grow at 6 to 6.5%. So deeper economic growth, and also governmental initiatives like PLI, and also a robust domestic demand, mainly urban demand, supported by a good amount of rural demand. These are some of the opportunities on the equity side, that's manufacturing, BFSI, and tech. On the fixed income side, we feel that we believe that there is sufficient room for short-term rates to move up a little more. Maybe 1 year to 1 year rates, 6 months to 1 year rates could move up by another 50 basis points to 45 basis points. Whereas at the long end of the curve, that's 10-year and the 10-year benchmark, there could be very limited movement on either side, where people define it as 720 on the lower side and probably 750 or 760 on the upper side. So we believe that maybe around 745, 750, if the 10-year benchmark moves up, that would make an attractive investment opportunity at the long end of the curve. Otherwise, as Bala mentioned, the best thing would be to be limited to maybe 2 to 3 year maturities, because you still have good portfolios in that maturity profile with a very high yield, say around even upwards of 8%. SDLs do make immense sense. SDL funds, the target maturity funds as we call them, they also make immense sense for investors who would like to stay for a longer time, because SDLs have been at around 760 to 790 levels even at the primary, and any exposure taken could give virtually tax-free, because of the indexation benefits and all that, with virtually not a very small amount of tax being paid. It could give maybe 680, 690 or even 7% returns virtually tax-free. These are some of the avenues that we have. Overseas markets definitely offer opportunities, as US markets, as also Europe, even China is looked at quite favorably. These are also opportunities that are available to our investors, and we continue to recommend these things on a regular basis.
Thank you, Doc. So to conclude, we have a rapid fire round, which basically consists of your views in numbers. But I know that Rahul and Arjun, being a part of the mutual fund industry, would not want to be nailed down in terms of giving an actual number. So let me start with you, Doc, in terms of where do you see the Nifty. Maybe if you're not comfortable giving a number, at least you can give a direction whether you see it up or down by December 2023. So
I think immediate trend would be lower, probably support levels, and medium term trend would be that it will be much higher, probably.
How about the 10-year benchmark yield by December 2023? Lower or higher?
It will be lower.
Dollar rupee exchange rate, lower or higher?
It will be, rupee will be cheaper, dollar rupee exchange rate will be higher.
Gold, higher
Gold
or
will
lower?
definitely be higher.
Great. Shailesh bhai, your views in terms of the benchmarks, Sensex and Nifty?
I'm almost completely in agreement with Doc. It is,
lower?
Yeah, definitely.
Okay. 10-year benchmark, lower?
I would say stable. I'm seeing, because of the two trends that we discussed, Arjun very beautifully outlined how things might move in terms of the US interest rate. They might go up and then they'll start falling. So I believe it will be a sideways movement.
And gold?
Gold, I have no view. I've never invested in gold, so I'll have to come and take Doc's advice.
Okay. Arjun, would you be comfortable answering these questions? Sensex, Nifty, up or down?
So Sensex, I think I'll give a pass on that.
Okay.
I genuinely don't really know. So the only thing on the Sensex I can say is that the last 22 years, Indian markets have tagged US markets directionally. The beta is lower, but the directionality still holds. On the 10-year, I think 7 to 725, I think is a very reasonable range. There are some concerns on the short term, the savings, small savings front. If those concerns actually don't play out, I think 7.25 is reasonable. On rates, I think we're expecting the RBI one more last hike from the RBI. And historically, you've seen that whenever the central bank pauses on the policy rates for a long period of time, nearly nearly 12 to 18 months ahead of the rate cut, the yields, the market yields start moving lower. So at the top, you actually start seeing market yields moving lower. So I think in line with the 7, closer to 7 is what I would want to think the 10 years going. The only thing that can really change this is crude, because the last 15, 20, 30 years, you've actually seen yields move in line with crude. That's the only risk.
Gold.
Gold, I think fairly range bound. So given that I'm expecting around 5-6% sort of weakness in the dollar, that 5-6% sort of gain in gold maybe, but broadly I think range bound. And if you're looking at gold, this is gold in dollar terms. Gold and rupee terms, I think you can add another 3% because I'm expecting around 3% depreciation of the rupee point to point end of 2020.
That still qualifies as higher.
Yeah, higher.
And the dollar rupee?
Yeah, dollar rupee 3%, probably around a 3% depreciation in 2023 from where we are now. Okay.
Rahul, coming to you, which ones would you be comfortable answering? Taking a view on the Nifty?
None of them.
Okay, all right.
But I think there is money to be made in the kind of sectors and stocks which I mentioned. I think that is what investors should focus on rather than getting bogged down by Nifty and Sensex levels. I think the market is going to be
active management.
Active broad-based market. It will be a broad-based market.
Okay, wonderful. Thank you, gentlemen, for being a part of this discussion today. I'm sure our HNI investors would be greatly benefited by your views. So till the next budget and till next year, have a great investing and wish you all the best to ride out 2023. Thank you.
Thank you.
Thank you.
Wonderful to be
Mr.
here. Thank you. Very well conducted.